Hi, we are going to have a quick look at what's short selling and go through a quick example to calculate the profits or losses that you could make when you're involved in a short sale. So here what we are seeing is that let's assume that there's a particular investor who's in touch with a broker. So the investor is in touch with a broker and instructs the broker to sell a particular number of stocks in behalf of the investor in the market. Now, in this case, when we talk about short selling, what we are saying is the investor doesn't own those shares. So the investor doesn't own those shares. So let's assume that the investor is giving instruction to the broker to sell a particular stock in a company Y in the market, which the investor doesn't own. So what the broker will do is, now remember, the broker will have various accounts with various investors. So the broker could have access to stock Y with another client of the broker. Let's assume that client B has Y shares in his account. So what the broker would do is the broker would borrow these shares from client B and short sell these shares in the market. Now, when we talk about short selling, the purpose of short selling, or the way short selling works, is that so let's assume in this case the shares are sold in the market for $10 each, and then so this happens in September, and then let's assume that the investor gives instruction somewhere in November to buy those shares back. In other words, to close the short sale. So the broker will have to buy the shares based on the market price of the stocks at that particular time in November. So let's assume the shares have dropped down to $5 each. So here you can see that due to this short sale, the shares were sold at $10, so plus 10. So that's the gain from the short sale. That's the gain from the short sale, $10. And then you purchase the stocks back in November at $5. So you could say you closed your short sale at $5 because you purchased them. When you buy the stocks, you have to pay the money, so that's minus -5. So that gives you a profit of $5 per share. So you can see a short sale is profitable when the stock price drops after the sale. Now, on the other side, if the stock price increases, for example, in November, when you want to close your short sale, if your stock price has gone up by, let's say, to $12 or $15, you're going to make a loss. So short sales work when the asset price drops, after the short sale has occurred. So in this case, the profit per share for the investor is $5. Now, another thing you need to remember is that during the time of the short sale, so in this case, the short sale occurred in September and it was open till November, until the short sale was closed out. So let's assume somewhere in October, let's assume there was a dividend of $1. Let's assume there was a dividend of $1. Dividend of $1 in this share. Now, what happens is that if there's any dividends during the period of the short sale, so that means from the time the share is shorted until it's closed out, any dividends should be paid back to the original owner, in this case to client B. So that means the investor will have to pay the dividend. So dividend will have to be paid. So in this case, $1 has to be paid back. The broker will take that money and put it into client B's account. So you can see when there's a dividend, the profit for the investor will be only $4. So that's important to remember. If there's any dividends, that dividend has to be passed on to the client or the party who owns the stock. So that's how a short sale works. Now in this case, of course, there won't be one stock. I just made it very simple in order to understand the concept. So if, for example, if there were 100 stocks that has been shorted, the profit from the short sale would be, so short sale would be 100 times $10. That will be $1,000 will be the initial income for the investor. Then there would have been a dividend in October. So dividend would be 100 shares into $1. That's minus 100 minus 100. That's minus 100. And then the shares will be purchased back at $5 each. So closeout cost, you could call it closeout cost, will be 100 multiplied by $5. And that's a negative because you have to pay. When you're purchasing back, you have to pay. So that's minus $500. So the total profit to the investor would be $400. Now, of course, if the party who shorted the stocks gets $400, let's assume that these shares were sold to another party called party C. So if this investor took the short position, then this investor would have taken the long position. So if this investor made a profit of $400 out of the short sale, then client C or party C would have made a loss of $400, who took a long position in this transaction. So what I'm trying to show you is that if one party, in this case the party who took the short position, makes a profit, the party who took the long position will make a loss. So vice versa, if the party who takes the short position makes a loss, then the party who takes the long position will make a gain. So that's short sales. And if you have any questions, drop me an email or put a comment and I can have a look. Thank you.